Happy Friday from Hong Kong. It's 9 a.m. here in the city, up in Beijing and in Shanghai. Welcome to Bloomberg Markets China Open. I'm David Ingles with Yvonne Man.
Our top stories this morning. Treasuries extend their rally after U.S. data shows a cooling jobs market. Meanwhile, the PBOC expected to skip its monthly liquidity injection for the first time this year as it weighs the impact of previous stimulus on the economy. And we are live in Niigata, Japan, where global finance leaders are gathering. We speak to European Commissioner for Economy, Paolo Gentiloni, this hour.
Yep, lots of good conversations coming up here. In terms of markets, though, we're doing okay today. On a weekly basis, we're slightly down. We're looking at about 0.1% to the upside. S&P future is about 8 points. So that's relatively decent for this time of the day here. So we are probably looking like a rally across global equities this Friday. We'll see how long this lasts. A pivot really to other markets opening up, and almost right in cue here, these markets opening up are perhaps going against what I just said. On high precision, out with earnings, 1.5%, early drag right now, 2% as I speak. Over in Taiwan, FX markets have been very much in focus, whether that's because of comments out of the ECB talking about inflation, whether that's the Bank of England leaving the door open, inflation bumping up that GDP forecast. Wow. And of course, that big drop across base metals yesterday, leading to where the Aussie is. And in fact, the Aussie is bouncing off that 50-day moving average after the sharp drop that we saw. And we're at 695, 696 on dollar China there. Commodity markets are stabilizing after what I alluded to there, although you are getting some contracts just playing a bit of catch down over in China. Very briefly, bond markets, we talked about this rally. Have a look at where we are. Within this, we're focused in on the 10 in China, which has been falling for, 10 straight weeks now, longest in 17 years. And the weakness coming through in the data this week, overall, wholesale has told us bond markets were correct here.
And you're starting to see that not just with China, but the U.S., right? Where you're starting to see PPI prices are cooling down, similar to what we saw with the inflation numbers earlier this week. Jobless claims all of a sudden also shot up as well. So you are seeing those cracks in the labor market potentially here. Is that sort of Fed pause in play now? But the credit data out of China, right? After the first 3 months of this surge in loan growth, things really started collapsing.
Yeah, and that was the bright spot, apart from exports. And then exports started falling, and then consumption, right? And this is probably the first full month where almost everything data was all consistently soft and negative, if you will. And perhaps that's also why we saw the drop in commodity prices overnight.
When you have zero inflation and also not much credit growth, it really kind of does not bode well for where this economy goes at the moment. This is not an economy that's firing on all cylinders, right? And then it adds more speculation out there that they're going to have to do something in the second quarter, policymakers, that is, policy cuts or something to revive things. Take a look at how base metals did overnight as well. How bad was the bloodbath?
It was the worst drop this year. So the trend has been going down anyway. I think on the commodities complex, the spot index, our spot index is back to about 18-month lows on that. To your point on Bloomberg Economics, I think we might get a move out of China this quarter, I think is their sort of base case scenario here. Shout out, of course, to Cameron Kreis, your macro man, for this chart. It's basically the same chart. We'll just fix that little typo you see on your screens there, but it's the same chart. China imports, base metals price, there's almost a mirror image there. So where do we find growth is the question. So that's showing up in the bond market. High yields are under pressure. That's for different reasons, but I guess the macro backdrop is not helping there when it comes to
we're going to have that
bonds.
credit tracker out of China coming out a little bit later on. But certainly we're talking about junk bonds, right, in China. Longest losing streak we've seen since July. A lot of those woes in the property market, right? This housing rout is not over. You saw that in the credit data as well. Yeah,
so if we have not depressed you enough 4 minutes into our show, why don't we try and perk you guys up with a different conversation?
Let's bring in Christian Hoffman, portfolio manager at Thornburg Investment Management, to walk us through the macro risks out there right now. Christian, it seems like, for fixed income, it opens up a lot of possibilities here right now. But then again, I'm looking at a 4-week T-bill where it's north, if not close to 6%.
Yeah, what we're seeing is really surrounding the debt ceiling and the confrontation there. That spike in short-term yields is troublesome. The thing that's funny is the less the market reacts to this risk that's coming down the pipeline, the more likely that risk becomes present in our lives, because it allows politicians to continue to play this game of brinkmanship. The funny thing is that, those short-term T-bills are really the eye of the storm, and that has been the security that investors have been the most enamored with. People can't get enough, and they're just piling into those. But it's almost tragically comic, because there are so many more interesting things to do in fixed income right now. You can buy short-term commercial paper and get almost 5.25% yield, and I can tell you that those companies have no chance of defaulting this summer. It's also an interesting time to play duration. Mortgages are more interesting than they've been since probably the global financial crisis. You're able to buy low coupon bonds in the low 80s with great convexity and great carry. I heard there was some progress today on the debt talks. That makes me feel optimistic. But the reality is that both sides remain very far apart. It's almost like they agree that they want to go have dinner together, but one side insists on going to Brazilian steakhouse, and the other side will go nowhere except Jamba Juice.
Yeah.
I like that.
Yeah, maybe a buffet bridges that gap. Well, speaking of some of your calls, you laid out some of the things that markets perhaps need to be paying attention to right now. Just in terms of portfolio construction, then how overweight are you as far as some of those issues are concerned then?
So we're taking a balanced approach to our portfolios, which is what we always do. Fixed income remains skewed to the downside. So we believe in the value of diversification. That's among position, that's among security and, subsector and really everything. If you're thinking about duration positioning, again, you're really rewarded on the front end of the curve, and actually taking some duration risk, extending out, notably beyond 10 years into the, 20s and 30s, where you pick up that additional yield. That's partly on the back of the rally that we've had on the 10-year. The 10-year has been range bound for a while, and we're kind of toward the tighter end of that range. So I think, again, that's partly a flight to quality. That's because of chasing that asset. And I think you need to look around the periphery to find more interesting things to do.
And Christian, we've been asked, is the Fed pause in play now? I just wonder, this divergence that we're seeing in what stocks and bonds are saying, what the Fed is saying, is that going to get resolved anytime soon? Yeah.
We've had a very reasonable CPI. We had a reasonable PPI today. This really takes the risk of a hike off the table for me. You think about over the next month, we're going to continue to get mixed data. The next CPI, I think, comes a day before the next Fed meeting. It will take, I think, some very negative readings to really put a hike back in play for June. June is going to be a pause.
All right. So it looks like based on that sort of calendar you've just laid out for us, volatility is about to pick up then. Would I position for a pickup in vol? And if I want to, how do I do that?
Yeah, I think having flexibility in your portfolio, having some dry powder in terms of cash, but also high quality assets will allow you to pivot. Okay. One thing that our team did extremely well in 2020 was, we sold positions down 2 and 5 points to buy securities that were down 10 and 20 and 30 points. You want to have that flexibility to pivot when things change. Volatility can be scary and exciting, but it's also, when we make some of our best trades and put on positions that, can yield dividends for years to come.
How is this whole sort of, I'm just wondering in terms of what we're seeing in terms of, you're saying that there's actually attractive opportunities in every sector of fixed income and then pockets within each sector. How clear-cut is that really right now in terms of the clarity that we're getting from the Fed? People are saying when it comes to credit, in particular the high-quality space, it is getting a bit more expensive. Do spreads need to widen a bit more to kind of get back into that market?
Yeah, I'd love to see spreads more. I think you need to be cautious in high yield, and I don't have the same enthusiasm for every sector. I think, floating rate securities and loans have done their part in portfolios and are actually, a place that you should be, selling down notably to reinvest in other things. Again, you don't want to buy the curve with, just equally weighted. You want to look for the points where, there's interesting opportunities. I think We're more constructive on structured product than corporates. We're more constructive on higher quality than lower quality. But broadly, you had this tremendous reset in last year in 2022, and that has reset the menu for everyone. And the opportunities are much better than we've seen in years.
Christian, your logo right behind you is forcing my hand because there are Chinese characters on there. What do you think of stuff outside the U.S.? And we've been talking about here in this side of the world. Junk bonds have been under pressure, mainly as a function of property. CGBs, China Treasuries, have been just on a tear. Just give us a sense of what you think, what's happening outside.
Yeah, I think, look, we're seeing optimistic things out of Europe. One of the things we're doing is buying some European corporates and actually, swapping back to dollars from euros, where you get a nice pickup to do that. The China situation, I think, remains in play. And, we're thinking more beyond just securities in China, where we have exposure, but also, how the China reopening and how those government policies actually, reverberate throughout economies throughout the world. Japan has been an interesting case for a long time. And if we see some normalization there, that hasn't been an interesting place to do fixed income for a very long time. But in coming years, it could begin to, begin to be again.
Okay. All right. Christian, have a great weekend ahead. Thank you so much for your time. Christian Hoffman, their PM at Thornburg Investment Management. All right, so let's get it over now. We'll stay in the U.S., but shift it over to New York. Vonnie Quinn, she's there. She has your first word news. Vonnie.
David, thank you and good morning. President Joe Biden's debt ceiling meeting with House Speaker Kevin McCarthy and other congressional leaders has been pushed from Friday to next week. According to White House officials, the postponement is a signal that the staff-level talks are making progress in the push to strike a deal to avert that historic breach of the debt ceiling. The president will instead meet with congressional leaders early next week. The largest banks face millions of dollars, billions even, in extra fees to replenish the U.S. government's deposit insurance fund. The assessment from the FDIC stems from the regulator's decision to insure all deposits at Silicon Valley Bank and Signature Bank. The FDIC estimates the move cost its deposit insurance fund around $15.8 billion. Thailand's consumer confidence in April has risen to the highest in more than 3 years. The index climbed to 55 from 53.8 in March, a steady increase for 11 consecutive months. The University of the Thai Chamber of Commerce says pre-election spending and foreign tourist arrivals are boosting spending. Consumers are estimated to have spent up to $886 million in the run-up to the election. Turkey's main opposition alliance is accusing Russians of meddling in the upcoming presidential election. Presidential candidate Kemal Kılıçdaroğlu said in a tweet that Russians were behind what he called conspiracies and deepfake content. Another opposition candidate has withdrawn from the race after denying bribery claims and the authenticity of an alleged sex tape. Global News, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Vonnie Quinn, and this is Bloomberg. Yvonne.
All right, still ahead, we're going to be live in Niigata, Japan, where global finance chiefs are gathering to discuss the biggest risks to the world economy. We'll speak to the European Commissioner for Economy, Paolo Gentiloni, later on this hour from the G7.
Yep. I'll try it too. Paolo Gentiloni.
Sorry.
There we go.
It's Friday.
Coming up, this is probably easier. Jamie Dimon. There we go. JP Morgan boss there talking about the differences between the U.S. and China can be sorted out more. From his exclusive interview with Bloomberg coming up next, and also counting down to the open of trade, Shanghai, Shenzhen, and this is Hong Kong. This Friday morning, we're looking at shares of Jindong, maybe a little bit Hanjidong, poised for a higher open. 16 minutes away. This is Bloomberg Markets China Open.
All right, your renminbi fix just crossing the terminal here, 694.81. That is just slightly weaker than what was expected here today. But obviously, we have seen quite a bit of weakness when it comes to the renminbi of late here. Obviously, with the bad data we've seen, credit, inflation, it hasn't been a good week when it comes to the macro front.
No, and arguably, some people, I would imagine, would be expecting the yuan to trade much weaker than the current levels, given also the drop that we've seen, right, in the market itself. And also just, at least geopolitically up until 2 days ago, perhaps the premium was higher. And then, but we had this conversation between, of course, Jake Sullivan and Wang Yi, perhaps in some ways pulling us back from the brink there when it comes to these geopolitical concerns here.
Yeah.
The meeting in Vienna, 2 days, I think, substantive talks.
I think it was like 8 hours of talks.
Yeah.
Albeit it is low level for now, but then again, it doesn't kind of lead the path to some sort of phone call between President Biden as well as President Xi Jinping. It seems like the strategy now is to keep pushing for these calls, whether it's with the defense officials and all that, the like, which China really hasn't responded to these phone calls.
No, the calls,
yet.
no, they haven't picked up the phone.
And at one point, does it make them look a little bit weak, the U.S. side of things, for sure? So a lot of questions about that strategy moving forward. But then again, does it help boost and turn things around in terms of market sentiment as well?
Yeah.
We spoke to JP Diamond, JP Morgan's top boss here, weighing in on ties between China and the U.S. An exclusive interview with Bloomberg. He says the two economies have differences, and that's okay.
This is a serious subject. And anything that relates to national security, I'm a patriot first, and I'm going to salute my government. So put that aside. What the government should do, and wants to do, and is now saying they are going to do, is have conversations. They're going to be tough, but they should be thoughtful. Certain things are really national security, certain things are not. Yep. And we shouldn't confuse the two. America and China have a lot of common interests: climate, nuclear proliferation, anti-terrorism, global stability. And we have differences. We're capitalists, they're not. And it's okay. We could sort that out, but we need to keep the Western alliances together, not just around war and Ukraine, but around strategic, economic relationships, including trade. We can't take trade off the table every time we talk to, Europe or Asia and stuff like that. So I would go back into TPP. I would surround the world. I'd want to keep the world safe for democracy, and I'd want to have open markets, particularly with Europe. And when I was here last time was when we passed the IRA Act. A lot of great things in that act. But there are things I don't like too much social engineering inside of it, but also it pissed off all of our allies.
But on the China side, so if they start doing more noise on finance, does that hurt Chinese growth?
Probably. I think you've already seen, it's not trade, but you've seen investment going both ways coming down. And that's okay in the short run, but in the long run we should say and the government's got to decide. This is not going to be business companies decide, nor should they. So when Congress criticizes business sometimes, there may be truth to that. They have to decide what is okay, what's not okay, what do they want, what's security, and that's around trade, that's around investment, and that's around sharing IP.
Okay, I give you £1 million, or maybe you take it, your own £1 million. Where do you invest right now?
Morgan. I wouldn't buy sovereign debt anywhere.
Why?
I think there's too much. The amount of fiscal stimulus took place and still surging through the system, the amount of QE, these were extraordinary numbers. And not just in the U.S., but in Europe and in other parts of the world. And when I say extraordinary, I mean extraordinary. And therefore, I think there's a chance you have more inflation than people think. So while the Fed controls short rates, they don't completely control longer rates. And that you could see longer rates ticking up because of higher inflation. And even if there's a mild recession, they continue to tick up. A lot of us experienced that in the 70s and 80s, and I would be a little worried about that. So rates are kind of low, spreads are still kind of low.
Okay, so you're not putting them in sovereign. Where are you putting that $1 million?
Central banks.
JP Morgan CEO JP Diamond then speaking with Francine Lacqua there. We got plenty more ahead. This is Bloomberg.
All right, looks like we're going to get a good day if you're long JD and friends. As you can see in the pre-markets right now, good beat on earnings. Let's bring in Catherine Lim, our Bloomberg Intelligence senior analyst, to talk us through these numbers. Let's start with that. How does the business look?
Right, it was definitely a good beat, particularly on the margin side. They actually improved margin on a year-on-year basis, and market was actually looking at a slight decline. And that margin beat actually came on top of a sales decline. And here we're just referring to the retail business of JD.com. So it was good set of numbers. They've looked like they've tightened actually the cost
Yeah.
It's a leaner cost structure that we now have going into the 618 shopping festival, which does mean that, even though they're going to throw out more perks, more promotions, they may be able to actually hold up their margins into this second quarter.
The CEO has only been on for about a year or so.
Yes.
What happened?
Right. Well, that's a good question. The good news is, of course, that there is a transition. We have a replacement, and this is the CFO that we're talking about, who is familiar with the business strategically. On the other hand, we don't know whether there's going to be any changes at this point in time. Doesn't sound like it, but who knows? Because I think this year, 2023, this is a very interesting year for the e-commerce companies. We're talking about consumers shifting offline versus online, and really it's because of a low base that we came from because of the zero COVID measures last year. So they're going to have to actually do a little bit more of strategizing to try and actually retain users on the platforms and continue to actually increase their expenditures online.
Is JD.com best positioned to take advantage of this? Because, shares are up today, but they've just been thrown out the window the last 12 months or so.
Right. Now, let's not forget PDD, Pinduoduo.
There's a lot here, yeah.
Yeah. Let's not forget, of course, we have Taobao, Tmall. There's the reorganization that's going on Alibaba, but I'm quite sure they will still be focused on their bread and butter for this year, right? So I think it's, anybody's guess, and let us not forget Douyin. Right?
Oh, yeah.
ByteDance, who's doing actually extremely well on the e-commerce side.
The shopping festival?
Yeah, 618.
What should we expect?
Right. Now, 618, bear in mind that, since last year, they have not given us any GMV numbers. They're not going to be providing more numbers for us. So, I think it's more going to be qualitative. I'm quite sure you get all that fanfare about, more brands coming in, more discounts, great stuff. But it's going to be hard to quantify without those numbers.
Okay, that's amazing. We have someone like you, of course, and your team covering this for us. Catherine Lim, of course, here in town with us, our Asia Pacific Consumer Senior Analyst at Bloomberg Intelligence. Going into the open here, so we talked about JD.com, a couple of other things that are taking place here. So we're talking property also and high-yield bonds on the way down, and I think we're at 5-month lows in this one.
Yeah.
This is a 10-month yield, okay, but on price we're also down in the other one. We talk about the credit tracker later on, of course.
Yes, where we are when it comes to this housing recovery, the like here, take a look at analyst actions to tell you about. We're focusing a little bit more on the metal space and what we've been seeing with here, Shaanxi Coal rated new attic, Wilson. Costco ship port cut to neutral at City. At SMIC, the price target raised by Goldman. They're talking about $21.4 now. They're basically saying that second quarter guidance really quite upbeat.
Okay. And going into that, too, that takes us into earnings reaction, broadly speaking, whether that's markets reaction or anything out of the analysts right now. There's also later today a quarterly review, HSI, and the final first quarter numbers, growth numbers out of Hong Kong. The open, minutes away. This is Bloomberg. Good morning. Happy Friday. Equity markets are bid. So is fixed income. I can't wait for the weekend because on the other side of it, monthly activity numbers are coming through.
Yay.
Yay. Small caps.
Yeah, we'll see if that really kind of changes the narrative here right now. When you have inflation basically the lowest in 2 years in China, you have this credit data where basically every segment, whether it was M2, new yuan loans, household, credit
just a breakdown
demand,
of all those things. Yeah.
everything seemed to have shrunk from the first 3 months of the year. Does this mean this whole recovery story, this whole pent-up demand is done? Or is it just, still on track, but we're just kind of seeing waves of this here right now? That's still the key question. Obviously, you're seeing markets are starting to price in that slowdown here, given what we've been seeing in CGBs and the like. We'll see if that rally continues in the government bond market here today. But we're watching all parts of the curve here this morning. CSI 300 is doing this. We're flat right now. Shanghai Composite slightly down. Hang Seng, though, we're about 100 points to the upside here. Keep in mind, we have that Hang Seng quarterly review today. So we're looking for some of these health and tech names to possibly be included. 8 shares are seeing a little bit more upside, about 0.5%. Some of the boards, as we talked about, it's all about CGBs. You actually had Citi say, look, they exited that trade targeting higher China rates and also neutralized they're China underweight in that EM bond portfolio. They're basically saying that now the data has disappointed. China banks are also reported to lower deposit rates. So maybe this means that bonds can continue to be bid up here. You're saying 271 for your Chinese 10-year yield. You're seeing 1 basis point higher on the 2 and the 5-year. Renminbi, we're still on the weak side, 695.93 here this morning. We're watching commodities, given the metals really falling out of bed on the back of that inflation data yesterday. It looks like we're continuing that sort of fallout for another day. Shanghai crude is down. Copper is down some 3% here right now. You take a look at what, in terms of earnings, maybe that's where we're going to see a lot bit more of the bright spots here across the equity markets. JD.com, JD Logistics reported
nice. Look at that.
bumper numbers there. Also, new change in the C-suite here with the CEO stepping down at JD.com. The CFO is going to take over. JD Logistics is up 4. SMIC, Goldman upgrading the price target as well, given that results were strong. Also, second quarter guidance was also upbeat. But then again, 20% revenue declines. That's the fastest or the biggest drop we've seen in about a decade or so. And we're watching, of course, it's the Hang Seng quarterly review.
Yeah.
There's a lot of picks out there about what could be. They're never quite right.
No.
But these are the ones being thrown around by analysts here today. Everything from JD Health, Li Auto, Kuaishou, If Ever Does, and Trip.com.
Who is in and out, and we'll find out. Happy hour time, literally here in Hong Kong. And if you're just waking up in the U.S., if you have nothing else to do, you can watch out, really. That's about, what, 5 a.m. local time? Index review to start out your day. Things get better from there. All right. Geopolitics, why not? A draft paper from the EU's foreign policy arm obtained by Bloomberg News has made it clear that the bloc does not want to be drawn into this conflict between China and the U.S. For more on this, let's bring in our Chief North Asia correspondent, Stephen Engel, who's covering the G7 finance ministers meeting in Niigata in Japan. And of course, Steve, you're with a special guest today.
Yeah, that's right. Hey, how you doing, Yvonne and David? We're here at the G7 in Niigata, of course, the finance ministers and central bank governors meeting, wrapping up tomorrow. And then, of course, this is a precursor to the leaders meeting in Hiroshima that begins at the end of next week, where we will also attend. But our guest is Paolo Gentiloni, European Commissioner for the Economy, also the former Prime Minister of Italy. Thanks so much for joining us here. Well, let's start with the China issues. I think David, the anchor, was just talking about how the EU maybe does not want to necessarily get drawn into the conflict that is sort of brewing behind the scenes between China and the United States. Janet Yellen yesterday, the Treasury Secretary, addressed these issues. How much, if I want to call it pressure, is the U.S. exerting on its fellow G7 members behind the scenes to come on board with exerting essentially more pressure on China because of what is being alleged is economic coercion?
Well, I don't think it's so much a pressure coming from U.S. I think it's lesson learned by the European Union. Lesson learned on the fact that we can't be too much dependent from foreign powers in our economy. This is also something that came very clearly from the Russian war in Ukraine in the energy sector. So we discovered that we were wrong, and we discovered that we were too dependent from Russian gas. We were able to, I think, to solve this situation, at least last winter, in a very effective way, but we have to avoid to repeat this mistake in the future. So we need our autonomy.
How would you define then de-risking versus decoupling, and what kind of economic shock are we talking about here? Because it seems as though there's a European shift, as you've just been alluding to. Olaf Scholz talked about, essentially China is viewed more now as a rival and a competitor. We have Italy signaling to the United States reportedly that they might opt out of the Belt and Road Initiative by the end of this year. It seems like these are pretty strong words and strong moves.
Well, I think decoupling would be a very dangerous risk for the global economy. I think especially for the European Union, which is definitely an open economy based on trade, it would be a big danger. What we are talking about is not closing our trade and our economic relation with China. What we are talking about is making our supply chains more secure and especially in some strategic sectors, so rare minerals, the clean technologies of the future, we can't be too much dependent from outside and too much dependent from a single country like China.
But the supply chains with China are so intertwined, it is very difficult to unwind those.
Well, I think you have to build your own capacity in some of these sectors. This is absolutely needed, and we have to do this, for example, on rare materials, working inside Europe. We have a lot of potentiality inside Europe for rare minerals, and we have to work in partnership, for example, with Africa. Partnership, not going there exploiting their own resources. But at the same time, this doesn't mean that we will not have economic and trade relation with China. This would be a danger for the global economy.
But how much support would there be within the European Union essentially to back U.S. efforts? We're hearing that Joe Biden might sign an executive order even before the leaders' meeting next week to limit specific investment by American companies into core technologies that are maybe managed by American companies, in integrated circuits, into quantum computing, into, of course, semiconductors and AI. Is that something that, choking China off from those access, is that something that would work to the detriment of the European Union, or something that you would support?
Well, for us, it's not to support or not. It is something that we have been deciding in the last couple of years. Yeah. So in Brussels, there was really a big change of attitude in the last 3, 4, 5 years. We were perhaps having an illusion that the increase of trade and economic relation would have brought to a more equal basis in these relations. And at the same time, we were not so much aware of the need of having a more secure supply chain system. Yeah. So we already introduced in our own regulation the scrutiny of investment in some key sectors. Yeah. This was not a measure against China. This was a measure to strengthen our autonomy.
Sure. Could I ask you as well, I mean, Janet Yellen started her press conference yesterday talking about the U.S. debt ceiling and the catastrophic impact of any default. Is this a distraction here at the G7, given all these other issues that need to be addressed?
Well, there is a strong feeling in the room of support to the administration effort and to Janet specifically. Overall, I don't know if we are right, because it's an internal issue for U.S., but of course with enormous impact in the world. But the impression I feel is that we are convinced that the common interest will prevail. So we will go on, they will go on, but at the end
they'll find an 11th hour solution, you believe?
At the end of the day, this is the common hope, but also the common feeling that I see.
What's your assessment on inflation? Obviously, core inflation in the European bloc essentially is pretty sticky right now. We had the Bundesbank president on yesterday. He's not necessarily ruling out the possibility of a September hike. That means, a couple more hikes, as Christine Lagarde has signaled, by July. How bad is inflation from your estimation, and is a September hike very much a possibility?
Well, the fact is that apparently inflation went up very quickly and is going down rather slowly, especially the core inflation. And for this reason, first, monetary policy should take its own decision, as the ECB repeat, based on data, and fiscal policy should not undermine monetary policy, which means that especially most of the measures that were introduced to support energy prices should be phased out gradually in the coming months. You know, we had a sort of love story between monetary and fiscal policy during the pandemic.
Right.
We were going spontaneously in the same direction.
You had a common enemy, if you will.
Now we have to organize this cooperation.
Well, let's talk about the next challenges on the horizon and the digital services, tax and global taxation. There's some stumbling blocks, obviously. When the truce over the digital services tax expires by the end of this year, could this spark a cross-Atlantic trade war? The pessimists say yes.
It should not. And I think the basis to avoid any tension is the fact that we work very hard to reach an agreement, which is still possible by mid-July at OECD level. And with an agreement at OECD level signed, I think that despite the different timing in the ratification of this agreement, which is obvious for political reason in different countries, we could stick to the common text agreed by the OECD and avoid these tensions. Of course, if there is no such an agreement, it will be a difficult task to avoid tensions, because we have some countries that have legislation until the end of this year. There is a pause, a suspension of this legislation, but to have this suspension postponed, we need to have reached at the same time a global agreement. So these two things are connected.
Yeah, but it's going to be a difficult challenge, wouldn't you agree, given that the United States necessarily would not want to open up its big tech companies to share taxation?
Well, I think that the big tech companies are among the supporters of a global agreement. What the big tech companies, in my view, don't like at all is to have a form of taxation in Spain, another one in France, another one in UK, another one in US, etc. They don't like at all this. Yeah. They prefer very much the idea of this agreement that we call Pillar 1.
Pillar 1, yeah. Can I talk briefly about the European Stability Mechanism, the ESM? Have you spoken with the Italian Prime Minister? Is there any movement that they will basically ratify the ESM? And what's holding it up? Well, I know the background issues, but what?
I think there are two different issues. One is, I think, legitimate and right that the Italians are asking to discuss on the future of the role of the ESM. I think this is an interesting discussion that I would also personally like to participate at. But I don't think that this should be connected to the ratification of the new statute of the ESM. This was a decision taken a couple of years ago, and this decision should be confirmed in the timing and in the way that the Italian Parliament will decide, but it should be confirmed.
When? By when? Has there been movement? You speak with the Italian Prime Minister.
For them, when is for them to decide. I would say as soon as possible, but this is a European Commissioner view. But of course, the fact that you discuss on the future of the ESM doesn't mean that you don't ratify what was agreed 2 years ago.
Finally, I want to get a blanket or a broad assessment of the European growth this year from your perspective. Are we heading towards a global recession or a European recession?
No, definitely no. We will present our economic forecast next Monday.
Can you give me a snippet of what might be in that?
Well, as you know, we had a first quarter with a moderate growth in the European Union, and I think we will have moderate growth for 2023, which is not recession at all.
All right. Paolo Gentiloni, thank you so much for joining us on Bloomberg Television. I know we covered a large range of issues, and I appreciate your time here at the G7.
Thank you.
Okay, guys, going to send it back to you from Niigata.
Great discussion, Steve. Thanks so much. Of course, we have some news and alerts to bring to your attention here when it comes to Fantasia. This is the Chinese developer. The stock has been suspended for some time now, but it seems like they're facing a key shareholder revolt on this whole restructuring plan here. So it seems like so far these debt plans have been quite disappointing. It leads to a lot of this angst that we're seeing in the junk bond market now. Yeah, yet another example of this very interesting segment we have ahead, of course, for you, the stresses reappearing in China's credit market. There's plenty more ahead. Specifically on that, this is Bloomberg. All right, commodity prices are headed back underneath where they came from. Commodities, that's when you look at where we are, some of these contracts in China. The other, perhaps related piece of the story here is pressure in the economy, pressure on the riskiest part of the junk bond market. Have a look at where we are. I think 5-month lows on this one as well. There we go. Our own measure of that, and perhaps also a reminder that this economy might need more support. It's just a lack of credit numbers coming through here. Big miss on credit numbers for the month of April. Slump on all forms of borrowing, right? You look at M2, corporate loans, household loans, even mid to long term to even short term loans. So like the big ticket items, like cars, for example, you're not seeing that. Contracted for the first time in 4 years as well. So on all accounts, it seems like this was a pretty bad print. Let's bring Loretta Chen joining us for more on this credit tracker. We just had news of Fantasia, possibly facing kind of this shareholder revolt around some of these debt restructuring plans. That doesn't really bode well for credit these days.
No, and I think the recent economic data that we're getting is just showing us the brief recovery had in March and April is fizzling out. So that's really not a good sign if you're a bond investor right now. And if you're betting on initially recovery because you saw all these stimulus from the government, then now you're giving a second thought about what those stimulus actually mean, because we haven't seen any concrete measure from the government for a long time this year. Okay, so the credit tracker onshore and offshore is slightly different. There was a deterioration onshore. Is that the takeaway from the latest one here? Yeah, so onshore, actually, we're seeing credit spreads under a bit of pressure. And I think right now the focus is really on those local government financing vehicles. Yep. So in the past months, actually, one of the poorest provinces in China, which is Guizhou, it's asking for help from the central government to deal with its debt troubles. So that just tells you the urgency of some of these local government trying to solve their debt problems. You know, these debts are piling up and they're not being able to sell land for the past year. And this is supposed to be a year of restructuring, and that these were supposed to kind of turn around sentiment. Why do you think these debt plans have really disappointed? Yeah, I think if you want to have a good restructuring plan, first of all, you have to have confidence in the actual business. And what we're seeing from the property market is it's not really giving you any signs that, developers like Fantasia or Evergrande is able to sell more units after the default. It's really a sentiment issue, right? Are people still willing to buy from these distressed developers? They probably would go to the SOEs right now, right? Because those are the stable ones. We're really seeing the winners and the losers, and maybe to your point here in the provinces, too, which we'll get to next time here, that Guizhou, of course, the poorest one. Might we see more of the more affluent provinces also find themselves in a similar situation? Loretta, thank you so much. Loretta Chen there, our bond and loans reporter. All right, let's talk a little bit more about Thailand now, heading to the polls this weekend with opposition candidates looking to unseat a military regime ruling for nearly a decade. Let's cross over to our reporter, Papicha Tanaka Sempipat in Bangkok. Really, just walk us through the mood on the ground here and what's expected.
Good morning, Yvonne and David. In Bangkok, the mood on the ground is very energized. We have a vote coming up on Sunday, and today actually is the last day for campaigning under the Thai electoral rules. So we can expect political parties to go all out as they have been doing in the last stretch for much of the past week and two, with rallies around Bangkok and all of the Thai provinces.
Who are the candidates to watch out for today? I guess for our global audience that perhaps might not be as familiar with the nuances here.
Sure. The candidates to watch out for in this election are basically cast into two categories. The first would be the conservative side, and the second would be on the opposition side. On the conservatives are, of course, led by Prime Minister Prayut Chan-o-cha, a former Thai army chief who toppled a civilian government in 2014 and has stayed in power ever since. And on the opposition side, we have Paetongtarn Shinawatra, a newcomer who's the youngest daughter of former Thai Prime Minister Thaksin Shinawatra, who's leading the Pheu Thai party to pursue a landslide win. And we have also Pita Limjaroenrat, the leader of the new progressive Move Forward party that's really popular among young voters.
And this is an economy where we are seeing maybe growth slow down, especially with the macro headwinds. Of course, we're seeing how China tourism, how that could maybe offset that. But what do you think are some of the going to be the key issues among these parties, and where does each party stand on them?
The key issue dominating this election revolves around the economy, because Thailand has been grappling with near record high household debt and very high inflation rates. And also cost of living has been pushed up. So the policies that most parties have been proposing basically revolve around populist handouts and as well as minimum wage increase and debt repayment freezing. It's basically been a one-upmanship among these parties, with the next party offering the higher number than the previous ones. And the cash injection is now expected to be around $92 billion from the top 9 parties in Thailand.
And very quickly here, how soon before we get a new prime minister?
After the Sunday vote, we have 60 days before the Election Commission is expected to announce the official results. We will get preliminary results right on the same night of the vote, but it won't be for maybe another month or two until we get official results with 90% of the House seats. So until then, there's going to be horse trading and negotiations in the back room. So, and according to the government's preliminary timeline, we might be able to get a new government in by the end of July or early August, after the House convenes for the first time and begins to pick the Prime Minister.
There we go. That's the process. Trust it, as they say. Patpicha Tanaka Sempipat there live for us out of Bangkok. Very quickly, let's check in on markets right now. JD.com out with really good earnings right now. JD Logistics, JD Health, all to the upside here. Developers also in focus. Financials, materials, and energy here.
Yeah, you're still watching when it comes to metals, given what we've been seeing with the macro data out of China. Not looking too good here today. And we're seeing developers are falling. The banks are also falling here today. Materials, look at that. On the Hang Seng, down close to 4% on that index. We'll get an update on those markets coming up at the top of this hour. This is Bloomberg.